Stocks, bonds, and ETFs. Explained for beginners. Welcome to Apex Finances, where financial literacy meets simplicity. If you've ever heard someone say, I just put some money into stocks, bonds, and ETFs, and you nodded like you understood, this video is for you. No jargon, no MBA required, just real talk about money, the way it should have been explained from the start. Let's begin. Stocks. Let's start with stocks. Imagine your favorite company like Nike or Apple. What if you could actually own a piece of it? That's what stocks are. When a company wants to grow, it sells shares to the public, giving people like you a tiny slice of ownership. If that company earns profits and grows, your slice goes up in value. But if it struggles, your slice can shrink too. Historical flashback. The first modern stock exchange launched in Amsterdam in 1602, when the Dutch East India Company offered shares to fund global trade expeditions. Investors were literally buying into adventure and risk. Bottom line, stocks equals ownership. You're a part owner. You win when they win. Next, bonds. A bond is what we call an IOU. Literally, I owe you. Here's how it works. A government or company needs cash, but doesn't want to give up ownership. So they say, lend us $1,000 today, and in 5 years, we'll repay you plus $200 interest. You're not buying into the company, you're lending them money and getting paid for your trust and patience. Historical moment. During World War II, governments issued war bonds. Citizens lent money to support the war effort and got repaid years later with interest. It was both patriotic and profitable. Bottom line, bonds equals lending. You loan money, they pay you back with interest. Lower risk than stocks, but usually lower returns too. ETFs finally. Let's unpack ETFs. ETF stands for Exchange Traded Fund. Sounds complicated? It's not. Think of an ETF as a basket. Let's say you want to invest in tech, but don't want to bet everything on just Apple. With an ETF, you can buy a bundle that includes Apple, Microsoft, Google, Tesla, all in one single investment. If one company dips, the others help balance it out. Less stress, more spread. Historical flashback. The first ETF launched in Canada in 1990. And since then, ETFs have exploded in popularity for one big reason: diversification, especially for beginners. Bottom line, ETFs equals baskets. They bundle multiple assets into one. Safer, simpler, smarter. Final recap. Stocks, ownership, bonds equals lending, ETFs, bundles. Now you're no longer in the dark. You're building your foundation, brick by brick, with Apex Finances. Hit that subscribe, tap like, and drop a comment if there's a topic you want us to break down next. Because the journey to wealth doesn't need to start with confusion. It starts right here with clarity.